Hi, today we are going to discuss interest rate parity theory. The last time we did purchasing power parity, right? So, first of all, what is interest rate parity? It is a theory that suggests a strong relationship between interest rates and the movement of currency values. In fact, you can predict what a future exchange rate will be simply by looking at the difference in interest rates in two countries. It's not always easy to grasp why the value of currencies can change. So, how currency rates and interest rates are intervened, we would come to know now. So, to understand interest rate parity, investor behavior in asset markets that results in interest parity can also explain why the exchange rate may rise and fall in response to market changes. So, if we want to say it in another way, interest parity can be used to develop a model of exchange rate determination. This is known as asset approach or the interest rate parity model. So, first step is to reinterpret the rate of return calculations described previously in more general or in aggregate terms. So, instead of using the interest rate on an year on 1 year certificate of deposit, that is a CD, we will interpret the interest rates in two countries as average interest rates that currently prevail. Similarly, we will imagine that the expected exchange rate is the average expectation across many different individual investors. The rates of return then are the average expected rates of return on a wide variety of assets between two countries. Just like purchasing power parity theory, you had the basket of goods. Here you have a variety of assets which carry interest rates, and we would be finding out the average and then working upon our interest rate parity theory. Also, we imagine that investors trade currencies in the foreign exchange market. So, each day some investors come to a market ready to supply a currency in exchange for another, while others come to demand currency in the exchange for another. So it is like a market where there is a ready exchange of currency and there is a constant supply and demand of the currency at the exchange rate. How to find out or how to calculate interest rate parity? So consider the market for British pound in New York depicted in this figure. We measure the supply and demand of pounds along the horizontal axis and the price of pounds, that is so this is how we are doing. This is the exchange rate on the vertical axis and the demand for pounds is on the horizontal axis. So let S pound represents the supply of pounds in exchange for dollars at all different exchange rates that might prevail. So the supply is generally by British investors who demand dollars to purchase dollar denominated assets. However, supply of pounds might also come from US investors who decide to convert previously acquired pound currency. So let demand for pound is D pound, D subscript pound that it is denoted with. And this is the demand for pounds in exchange for dollars at all different exchange rates that might prevail. So the demand is generally by US investors who supply dollars to purchase pound denominated assets. And of course, demand may also come from British investors who decide to convert previously purchased dollars. Now, you can see it in this figure. So, which implies that exchange rate of dollar to pound rises, return on this pound falls. So this means that British investors would seek to supply more pounds at higher pound values, but US investors would demand fewer pounds at higher pound value. So this explains why the supply slope curve is upwards and demand curve slopes downwards. So the intersection of supply and demand specifies the equilibrium exchange rate and the quantity of pounds traded in the market. When the foreign exchange is at equilibrium, it must be that interest rate parity is satisfied. This is true because the violation of interest rate parity will cause investors to shift funds from one country to another, thereby causing a change in this exchange rate. And that is how, through interest rates, the exchange rate is determined. Calculating interest rate parity. Interest rate parity plays an essential role in foreign exchange markets, connecting interest rates, spot exchange rates, and foreign exchange rates. IRP is the fundamental equation, or interest rate parity is basics that govern the relationship between interest rates and currency exchange rates. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same regardless of their interest rates. Interest rate parity is the concept of no arbitrage in the foreign exchange markets, the simultaneous purchase and sale of an asset to profit from a difference in the price. Investors cannot lock in the current exchange rate in one currency for a lower price and then purchase another currency from a country offering a higher interest rate. What is the formula for interest rate parity? SO multiplied by 1 plus IC upon 1 plus IB, where F naught is forward rate, S naught is spot rate, interest rate in country C is IC, and interest rate in country B is I subscript B. How does interest rate parity works? So let us say there is a spot exchange rate of 0.75 British pounds for every US dollar. This means we can exchange $1,000 and receive 750 pounds. If interest rate in UK are 3%, we can invest 750 pounds at 3% for the year, yielding $772.50. Now, let's say that instead of exchanging our currency and investing in United Kingdom, we first invest our money in United States and exchange it for British pounds in an year. And let's say the interest rate in US is 5%. In this case, the exchange rate will be the forward exchange rate, which is calculated using the difference in interest rates. In this case, the formula would be 0.75 into 1.03 upon 1.05 or 0.7725 upon 1.05, rounding up, the resulting total is 0.736. So now let's say we start with $1,000 and invest it in US at 5%. The result is 1,050 at year's end. We then exchange $1,050 at the forward exchange rate of 0.736 or about $772.50. In other words, we end up with the same amount of money as if we had exchanged our money first and then invested it in United Kingdom. So this is how the interest rate parity is proven. So forward exchange rates for currencies are exchange rates at a future point in time as opposed to the spot exchange rates, which are current rates. An understanding of forward rates is fundamental to IRP, especially as it pertains to arbitrage. Forward rates are available from banks and currency dealers for periods ranging from less than a week to as far as out as 5 years and more. As with spot currency quotations, forwards are quoted with a bid-ask spread. So the difference between the forward rate and spot rate is also known as swap points. If this difference, that is forward rate minus the spot rate, is positive, it is known as forward premium. And if this difference is negative, it is termed as forward discount. A currency with lower interest rates will trade at a forward premium in relation to a currency with a higher interest rate. For example, the US dollar typically trades at a forward premium against the Canadian dollar. Conversely, the Canadian dollar trades at a forward discount versus the US dollar. What about covered versus uncovered interest parity? So, interest rate parity is said to be covered when the no arbitrage condition could be satisfied through the use of forward contracts in an attempt to hedge against foreign exchange risk. Conversely, the IRP is uncovered when the no arbitrage condition could be satisfied without the use of forward contracts to hedge against foreign exchange risk. The relationship is reflected in the two methods an investor may adopt to convert the foreign currency into US dollars. One option an investor may take is to invest the foreign currency locally at the foreign risk-free rate for a specific period. Now, the investor would then simultaneously enter into a forward agreement to convert the proceeds from the investment into US dollars using a foreign exchange rate at the end of the investing period. Now, the second option would be to convert the foreign currency to US dollars at the spot exchange rates and then invest the dollars for the same amount of time as in option A at the local, that is the United States, risk-free market. Now, when no arbitrage opportunities exist, the cash flows from both options are equal. So, IRP has been criticized based on the assumptions that come with it. For instance, the covered interest rate parity model assumes that there are infinite funds available for currency arbitrage, which is obviously not realistic. When futures or forward contracts are not available to hedge, uncovered interest rate parity does not tend to hold in the real world. So, if it is about covered interest rates and the uncovered interest rates, we have to see certain logics behind it, because it is, when is it covered? When the no arbitrage condition could be satisfied through the use of foreign contracts. And if we talk about uncovered rates, so when the no arbitrage condition is satisfied without the use of forward contract to hedge against exposure to exchange rate risk, interest rate parity is said to be uncovered. So risk neutral investors will be indifferent among the available interest rates in two countries because the exchange rate between these countries is expected to adjust such that the dollar return on dollar deposits is equal to the dollar return on euro deposits, thereby eliminating the potential for uncovered interest arbitrage profits. So, uncovered interest rate parity helps explain the determination of the spot exchange rates. So, uncovered interest rate parity asserts that an investor with dollar deposits will earn the interest rate available on dollar deposits, while an investor holding euro deposits will earn the interest rate available in the eurozone. But also potential gain or loss on euros depending on the rate of appreciation or depreciation of the euro against the dollar. Economists have extrapolated a useful approximation of uncovered interest rate parity that follows intuitively from these assumptions. If uncovered interest rate parity holds such that an investor is indifferent between dollar versus euro deposits, then any excess return on euro deposits must be offset by some expected loss from depreciation of the euro against the dollar. Conversely, some shortfall in the return on euro deposits must be offset by some expected gain from appreciation of the euro against the dollar. A more universal way of stating the approximation is the home interest rate equals the foreign interest rate plus the expected rate of depreciation of the home currency. If we talk about covered interest rates, when the no arbitrage condition is satisfied with the use of a forward contract to hedge against exposure to exchange rate risk, interest rate parity is said to be covered. So investors will still be indifferent among the available interest rates in two countries because the forward exchange rate sustains equilibrium such that the dollar return on dollar deposits is equal to the dollar return on foreign deposit, thereby eliminating the potential for covered interest arbitrage profits. Furthermore, covered interest rate parity helps explain the determination of the forward exchange rate. So, covered interest rate parity is found to hold when there is open capital mobility and limited capital controls. And this finding is confirmed for all currencies freely traded in the present day. One such example is when the United Kingdom and Germany abolished capital controls between 1979 and 1981. So Morris Opsfeld and Alan Taylor calculated hypothetical profits as implied by the expression of a potential inequality in the CIRP equation, that is a difference in returns on domestic versus foreign assets during 1960s and 70s, which would have constituted arbitrage opportunities if not for the prevalence of capital controls. However, given financial liberalization and resulting capital mobility, arbitrage temporarily became possible until equilibrium was restored. Since the abolition of capital controls in United Kingdom and Germany, potential arbitrage profits have been near zero. Factoring in transaction costs arising from fee and other regulations, arbitrage opportunities are fleeting or in fact non-existent when such costs exceed deviations from the parity. While CIRP generally holds, it does not hold with precision due to the presence of transaction costs, political risks, tax implications for interest earnings versus gains from foreign exchange, and differences in the liquidity of domestic versus foreign assets. So, researchers found evidence that significant deviations from CIRP during the onset of global financial crisis in 2007 and 8 were driven by the concerns over risk posed by counterparties to banks and financial institutions in Europe and the United States in the foreign exchange swap market. So, the European central bank's effort to provide US dollar liquidity in the foreign exchange swap market, along with similar efforts by Federal Reserve, had a moderating impact on the covered interest rate parity deviations between the dollar and the euro. Such a scenario was found to be reminiscent of deviations from covered interest rate parity during the 1990s, driven by struggling Japanese banks which look toward foreign exchange swap markets to try and acquire dollars to bolster their creditworthiness. So, when both covered and uncovered interest rate parity hold, such a condition sheds light on a noteworthy relationship between forward and expected future spot exchange rates. We can take an example of the covered interest rate parity with, if we assume Australian Treasury bills are offering an annual interest rate of 1.75%, while US Treasury bills are offering an annual interest rate of 0.5%. If an investor in the United States seeks to take advantage of Australia's interest rates, the investor would have to exchange US dollars to Australian dollars to purchase the Treasury bill. Thereafter, the investor would have to sell a 1-year forward contract on the Australian dollar. However, under the covered interest rate parity, the transaction would only have a return of 0.5%. Otherwise, the no arbitrage condition would be violated. So, what is the conceptual basis for IRP? IRP is the fundamental equation that governs the relationship between interest rates and currency exchange rates. Its basic premise is that hedged returns from investing in different currencies should be the same regardless of their interest rates. Essentially, arbitrage, that is the simultaneous purchase and sale of an asset to profit from a difference in the price, should exist in the foreign exchange markets. In other words, investors cannot lock in the current exchange rate in one currency for a lower price and then purchase another currency from a country offering a higher interest rate. A study of central bank interventions on the US dollar and Dutch mark found only limited evidence of any substantial effect on deviations from the UIRP. Now, UIRP is the uncovered interest rate parity. So, this has been found to hold over very small spans of time with a high frequency of bilateral exchange rate data. So, test of uncovered IRP for economies experiencing institutional regime changes using monthly exchange rate data for the US dollar versus the Dutch mark and the Spanish peseta versus the British pound have found some evidence that uncovered IRP held when US and German regime changes were volatile and held between Spain and United Kingdom, particularly after Spain joined the European Union in 1986 and began liberalizing capital mobility. Why is interest rate parity important? So, interest rate parity is an important concept. If the interest rate parity relationship does not hold true, then you could make a riskless profit. The situation where IRP does not hold would allow for the use of an arbitrage strategy. For example, let us look at the scenario where the forward exchange rate is not in equilibrium with the spot exchange rate. If the actual forward exchange rate is higher than the interest rate parity foreign exchange rate, then you could make an arbitrage profit. To do this, you would borrow money, exchange it at the spot rate, invest at the foreign interest rate, and lock in the forward contract. At maturity of the forward contract, you would exchange the money back into your home currency and pay back the money you borrowed. If the forward price you logged in was higher than the interest rate parity equilibrium forward price, then you would have more than the amount you must pay back. You have essentially made riskless money with nothing but borrowed funds. So, interest rate parity is also important in understanding exchange rate determination. Based on the interest rate parity equation, we can see how changing the interest rate can affect what we would expect the spot rate to be at a later date. For example, by holding the foreign currency interest rates steady and increasing the home country's interest rates, we would expect the home country currency to appreciate in relation to the foreign currency. This would affect the expected exchange rate. Interest rate parity condition. Interest rate parity refers to a condition of equality between the rates of return on comparable assets between two countries. So the term is somewhat of a misnomer on the basis of how it is being described here, as it should really be called rate of return parity. The term developed in an era when the world was in a system of fixed exchange rates. Under those circumstances, and as will be demonstrated or has been actually demonstrated, rate of return parity did mean the equalization of interest rates. However, when exchange rates can fluctuate, interest rate parity becomes rate of return parity, but the name was never changed. If we talk about the comparative statistics in the interest rate parity theory, the comparative statistics refers to an exercise in a model that assesses how changes in an exogenous variable will affect the values of the endogenous variables. So the endogenous variables are those whose values are determined in the equilibrium. In the interest rate parity model, the endogenous variables are the exchange rate value and, of lesser importance, the quantity of currencies exchanged on the foreign exchange market. The exogenous variables are those whose values are given beforehand and are known by the model's decision makers. In the IRP or interest rate parity model, the exogenous variables are those that influence the positions of the rate of return curves, including the United States interest rate, the British interest rate, and the expected future exchange rate. Another way to describe this is that the endogenous variable values are determined within the model, while the exogenous variable values are determined outside of the model. So comparative statistics exercises enable one to answer a question like what would happen to the exchange rate if there were an increase in United States interest rates. When assessing a question like this, economists will invariably invoke the ceteris paribus assumption. Ceteris paribus means that we assume all other exogenous variables are maintained at their original values when we change the variables of interest. Thus, if we assess what would happen to the exchange rate, that is an endogenous variable, if there were an increase in United States interest rate, that is an exogenous variable, while invoking ceteris paribus assumption. Then ceteris paribus means keeping the original values for the exogenous variable. In our case, it is the British interest rate and the expected future exchange rate, which are fixed. Now, it is useful to think of a comparative statistics exercise as a controlled economic experiment. In the sciences, one can test propositions by controlling the environment of a physical system in such a way that one can isolate the particular cause and effect relationship. Thus, to test whether a ball and a feather will fall at the same rate in a frictionless vacuum, experimenters could create a vacuum environment and measure the rate of descent of the ball versus the feather. In economic systems, such experiments are virtually impossible because one can never eliminate all the frictions. However, by creating mathematical economic systems like an economic model, it becomes possible to conduct similar types of experiments. A comparative statistics exercise allows one to isolate how a change in one exogenous variable affects the value of the equilibrium variable while controlling for changes in the other variables that might also affect the outcome. So, this way we compare statics in the interest rate parity theory with considering exogenous as well as endogenous variables, keeping the ceteris paribus assumption, and having an exercise in controlled economic environment. These are the references for interest rate parity theory. Thank you so much for listening.